Hi, this is Judith Paquette, and we're starting out with accounts receivable. This chapter's topic is accounts receivable, and I want you to imagine that you own a company. Let's call it a software company. This company has a client, also known as a customer. The client hires your company to build a website for it. The website is complicated. Several pages are included. It includes how to order, the ability to order, lots of information. Your company builds the website, and the final product is ready in 5 weeks. Then your company bills the client. And let's say the customer pays promptly in 30 days or about 4 weeks. Consider this. Your company, has been working for 9 weeks on a project without payment, and then it gets paid. That's a long time to go without cash when there are other bills to be paid. Of course, your company could ask for an advance payment up front or progress payments where the customer pays a little bit along the way. But without those payments, the wait time would be about 9 weeks. And what if the customer does not pay its bill? What if it can't? That means it has no money. Or what if it won't, in a case in which the client feels that the service provided just wasn't acceptable? Period. That is what we're going to talk about in this chapter, among other topics. We are going to discuss accounts receivable, how we value it, how we write it off if necessary, which means that we give up on the customer being able to pay the bill, how we recover it, and that means at one point we wrote off the bill, and later on the client says, now I can pay, I'm able and willing to pay. We'll also look at the requirement to estimate bad debts. What are bad debts? These are bills that we forecast, that we estimate will not be paid. Of course, if you knew a customer would not pay you, you would not sell to that customer. And that is why we say estimating bad debts. And you have to book a journal entry for that. In addition to accounts receivable, we'll look at notes receivable, where there's interest involved, and also how to accelerate, how to speed up collections of accounts receivable, and how these accounts show up on the balance sheet. There are 3 main types of receivables. The first one you've already studied in Accounting 201, accounts receivable. This is also called trade receivables, which is trade refers to operations, the business of the company, the core business of the company. For Starbucks, an example of that would be selling coffee. Notes receivable, as I said, is a single note in which interest is also paid, in addition to paying back the principal or the loan. And other receivables, often loans to employees. It can also be interest from investments owed but not yet paid, income tax refunds, etc. But let's review. Please start writing down the journal entries I show you in the PowerPoint slides, and they will form your guide as you go into the homework problems and to the exams. So, review from Accounting 201. Let's say a company, Jiantong, sold $1,400 worth of cell phones to Radio Shack. What's the journal entry to book a sale on credit? Debit accounts receivable and credit sales. But we know there's another side of this entry. If Jiantong sells cell phones, we must also account for the inventory. But you don't know what the cost of the inventory was for Jiantong, so we need more information. So let's assume gross margin is 28%. That means the cost of the inventory, or cost of goods sold, is going to be 72%. Remember, gross margin is equal to sales, in this case $1,400, minus the cost of goods sold, equals gross margin. Here we're just dealing with the percentages. I haven't given you the dollars. You need to calculate it. So we're going to use 72% for cost of goods sold. Therefore, cost of goods sold is 1,008 and inventory is credited 1,008. And remember, we are doing Jiantong's books. We are not doing Radio Shack's books. So for Jiantong, inventory was credited or it went down. Cost of goods sold and expense goes up. Let's go on with our review. On November 9th, Radio Shack returned $200 worth of cell phones to Jiantong. Again, assume gross margin is 72%. Remember, we don't debit sales, we debit sales returns and allowances. And remember, sales returns and allowances is a revenue account, but it is a contra revenue account. So revenue normally has a credit balance, but sales returns and allowances reduces revenue, so it has a debit balance. Accounts receivable is also reduced because we're reversing the sale. We put the phones back into inventory at 72% of $200, and cost of goods sold is reduced by the same amount. Finally, the customer pays the bills. Radio Shack pays Jiantong what they owe them. Alright, so right here we're going to show two different entries. Let's say Radio Shack pays without taking the discount. How much does Radio Shack owe? The $1,400 minus the $200, they owe $1,200. So here's the payment coming in: debit cash, credit accounts receivable, $1,200. Let's assume that Radio Shack takes the discount, and I'm giving you the terms right here. 2% discount if paid in 10 days, otherwise the whole amount in 30 days. So accounts receivable still goes down that same amount, $1,200. But the cash that comes into Jiantong is only 98%, and the difference goes to sales discount. Sales discount, remember, is a revenue account, but it's a contra revenue account, and therefore its normal balance is a debit. This ends the first video.